Good afternoon, friends. I'm Sandeep Biani, heading business development and sales for Alpha Accurate Advisors. Welcome to Alpha Accurate Advisors AAA Investor Connect. First of all, on behalf of Alpha Accurate Advisors, I would like to wish you a very happy and prosperous new year 2023. Friends, the year 2022 has finally come to an end. S&P 500 was down almost 20% by the year's conclusion. At the same time, Nasdaq was down about 32%. However, Nifty 50 was up 3%. This occurred despite the global chaos in other developed and emerging markets. By investing more than $39 billion domestically, Indian investor boosted the market spirits and contributed to the India's resilience and strength. While others think this decoupling of India from the global markets will not sustain for long, we think it marks the beginning of India's decade, a new period of growth and prosperity. So fasten your seatbelts and let's visit our own motherland, India, from AAA's perspective. Let us zoom into India. To present AAA's perspective, I would like to invite our founder and managing director, Mr. Rajesh Kothari. Welcome, Rajesh.
Thank you, Sandeep.
Rajesh, as I'm seeing, there are many new attendees in this call and many may be listening to you for the very first time. For their benefit, I'd like to request you to please start your presentation with throw some light on our investment philosophy, AAA's investment philosophy, and then you can take on the zoom into India topic. Thank you, Rajesh. Over to you.
Thank you, Sandeep. First of all, good evening, everyone. Wish you great 2023. As Sandeep has rightly started the ball rolling on, 2022 was probably what I would say a year full of events. Most of the things which one would not have expected has happened in 2022, be it Russia-Ukraine war, be it supply chain problem, be it crude oil prices, be it commodity prices, world markets down, and of course, India resilient. So, of course, we'll go into market outlook. But as Sandeep has said, let me first, in about 5-6 minutes, give a little bit brief about our investment philosophy, our processes, and then we move to the market outlook. Please give me one moment. Just a minute, please give me one moment. I'm just sharing my screen.
Yeah, sure.
I hope this screen is visible, Sandeep. Okay. So, friends, Alpha Accurate Advisors, the key differentiation between us and many other products in the market, one most important thing is at Alpha Accurate Advisors, founder is fund manager. So that means no risk of change in guard. Something very important because ultimately we are trustee of your hard-earned money, and when it comes to managing somebody's money, it is most critical who is managing your wealth. Second, very important when it comes to our differentiation is we have a client-centric business model. We have no conflict of interest. We are not into any other business like broking or wealth management or so on and so forth. So only one business, investment management. Third, very important is we are one of the few PMS firms in the country with a 13+ years of track record. And in the last 13 years, we have delivered 18.5% compounded returns compared to benchmark returns of 12%. We have received many awards on the street for the best risk management as well as the best 10 years performance award by PMS AIF World as well as by the APAC Insider UK-based publication as the best PMS provider in India in 2021. So, that's why, we say that this is basically our core positioning in terms of why AAA compared to any other product. When it comes to investment philosophy, I'm sure many of you would be followers of Warren Buffett, and even we are followers of Warren Buffett. And as he mentioned, rule number 1, never lose money. And rule number 2, never forget rule number 1. So risk management is critical. And that's why the tagline of our Alpha Accurate Advisors is protect capital, create wealth. When it comes to protection of capital, we have a DSD approach. We diversify our portfolio across companies, across market cap, across sectors. Why we diversify? Because we believe that governance risk, technology risk, and business cycle risk can be mitigated only through diversification. There is no other way to mitigate that risk. Second, very important is staggered approach. We do not follow model portfolio. And last but not least, something very important, everybody knows what to buy. Tell me when to sell. So a very strong discipline exit strategy, and that basically helps us to always keep revisiting our investment thesis to make sure that it is aligned to the underlying earnings growth. When it comes to wealth management, we have a very unique but very effective 3M approach: market size, market share, and margin of safety. By the companies where size of opportunity is huge, but very importantly, by the businesses which are market leaders in their respective sectors. And of course, you buy at the right valuations. It is through that approach, buying the leadership, that not only helps us to protect wealth, but actually also helps us to create, it not only helps into create wealth, but also helps into protection of capital, because we are buying the businesses which are monopolies in their respective sectors. One important slide which I thought to share with you, because many times investors ask us that how do you basically implement the exit strategy? And we always believe that agility is our mantra. And markets are dynamic, world is changing very fast. The crude oil from 70 to 130 and 130 to back to 70, and many more such factors that makes actually business cycles becoming shorter every day. And this slide we are trying to showcase that how we have changed our companies and sectoral weightages to make sure that portfolio always has a very strong underlying earnings growth. So say, for example, automobile, we have increased our weightage consistently. We have been bullish on this sector from last 2 years, and from 5% again, we increased to 8%. And if you look at the BSE Auto Index performance, it is almost at up 29% in last 1.5 years. And same is for banking. Weightage is increased from 24% to roughly 33%. And in this period, banking index is also up 11% and further 17%. It means roughly about 30%. Capital goods is one sector. The engineering, that's capital goods is one sector which we, like from almost like last 2 years, and probably one of the, early identifier of this theme. We have bought about 11% of portfolio since March 2021, and then we further increased to about 12.5%, 13%. And if you look at the BSE Capital Goods Index performance, almost up 50% in last 18 months. Software is one sector where we increased the weightage 1.5 years, 2 years back, and then we reduced in March 2022. And when we reduced the weightage, if you look at the IT index, that also basically actually delivered the negative returns of 21%. And we actually sold in month of March. So basically, agility is something very, very critical, because it allows us to make sure, as I said, that what is the underlying earnings growth of the portfolio companies, and are we overpaying for that growth or not? These are the two things which we constantly ask to ourselves while managing clients' money. And it is that strategy which results into this resilient, consistent performance. So AAA IOP is our flagship PMS plan, 50 stocks multi-cap, 18% compounding returns since last 13 years, compared to benchmark returns of 12%. AAA Focus PMS plan, we opened up recently, although the PMS plan is almost 8 years old plan. This plan is delivered 14% compounding, is a 30 stocks portfolio, primarily into large cap and mid cap. And AAA Budding Beast is our new offering, is an offering in our mid and small cap space. This plan is delivered about 25.5% compounding, despite in month of since we launched in January, February 2021, markets are actually were up in a big way. And of course, that time we were under investing. But if you look at last year, 1 year return, AAA Budding Beast has delivered about 5% return compared to almost flat returns by the indices. This plan is again doing extremely well. It is a mid and small cap offering with a 50 stocks diversified portfolio. And of course, I will go a little bit explain you about that plan probably at the end of the presentation. So this is about the Alpha Accurate Advisors, and now let me quickly move into what is our market view, zooming on India. Friends, during last 3 to 4 months, at times we have got this question that, do you think India will go through the same pain like how the market in the world market experienced the pain in 2008? And we think the best is to check the facts and figures before we conclude whether the answer is yes or no. And therefore, this slide is basically telling you how India is positioned currently compared to where India was in 2008. If we look at the corporate debt to GDP, it was 65% in 2008. Currently, we are at 51%. If you look at our exports from 167 US billion dollars, we are right now at 500 US billion dollars. If you look at our CPI inflation, is much lesser compared to where it was in 2008. Now let's look at the left-hand side chart, because what happened in 2008, the severe pain, the correction, because there were excesses got built into the system. And that's get reflected in non-food credit, 30% growth for 3 years. I mean, it was a strong excess double-digit growth, 30% when economy is growing at 11, 12% in nominal terms, 30% credit growth for 3-4 years. If you look at housing loan, again 25%. If you look at the personal loan, 26% compounded growth. Now look at last 3 years where India is. Our non-food credit growth is just 11% in last 3 years. Our housing loan is 12 to 13%. Our personal loan is about 14-15%. So we are nowhere near the excesses, and therefore we don't think that fundamentally from the economic perspective, it is going to be that kind of a painful period like what we have seen in 2008. The banking was the major issue in 2008 globally, and to some extent even in India, whereas today, even the global banks' balance sheet are much cleaner, and even the Indian banking balance sheet is completely well cleaned up and as well as now ready for growth. So we believe that this time it is different. We are not going to repeat 2008. If we look at important non-food credit growth, and I'll go a little bit deep into this slide, and this is the slide for last almost FY93 to FY23, so 30 years time frame. And you look at 2003 to 2008, as I was telling you, the growth was exceptionally high for 5-6 years, 26% per year. And if you look at last 3 to 4 years, the average growth is just 10%. And 30-year average is 16.5%. So we are too far from the buildup of the excesses. So, and hence we are not worried. Second important thing is India's digital infrastructure. While everybody knows that on physical infrastructure, we are lagging behind. Thankfully, when it comes to digital infrastructure, we are well ahead of the world markets. If you look at the Aadhaar cards, almost 90% of population has digital ID. If you look at the smartphone penetration is zoomed. If you look at the 15+ year population having bank account, almost 90% kind of a penetration. If you look at the digital transaction in terms of the volume share, it has already crossed 55-60%. If you look at in value terms, it has crossed almost 40 trillion. So I think on digital, we have done extremely well, and I think that's going to be our strength in future because it will make it has a multiplier impact on the economy. If you look at the Open Credit Enablement Network, OCEN, it's a game changer for the Indian economy. Friends, India is underpenetrated market when it comes to credit. Many individuals, many families, many households, micro enterprises, small scale, and even medium enterprises, they do not get credit. Either they don't get it or they don't get it on the right terms. This initiative of Open Credit Enablement Network is going to be a game changer because it will connect the consumer to the lender. So for example, if you are buying something, for example, from the NICA, and NICA therefore by your behavior pattern now knows that you are a good customer with its own internal rating, credit rating mechanism or whatever, then they can basically make you available to the set of lenders, which is looking for similar borrower profile. So there are 30+ consumer facing entities. They are already transforming into lending service providers. So a company which is through a digital platform will not only sell you the policy, the insurance policy, it will not only sell you the, the kirana for the grocery store, but it will also make credit available by becoming a bridge between borrower and lender. And friends, believe me, the world is watching this initiative very closely, and more number of companies, the more and more number of borrowers, more and more number of small and medium enterprises are getting enrolled into this network, and this network can potentially reduce the cost of capital and also increase the credit penetration into the country significantly. If we talk about China Plus One, we talked about it from last almost, I think, 1 year back, and we believe the opportunities remains huge. Even if you assume 1% shift from China to India, then exports growth can be 10%. If you assume 3% shift from China to India, it can be 32% growth. If you assume just 5% shift from China to India, it can offer you 53% growth. Across segment, agrochemical, pharma API, dyes and pigments, our market share is absolutely minuscule market share. So even a 3, 4, 5, 10% shift from China to India can play a meaningful role for corporate India, because it can offer 18, 20, 30% kind of a growth for next 3, 5, 10 years. Europe Plus One is another opportunity which we talked in detail, and like we mentioned in last 4 months back, that we are very bullish on this Europe Plus One advantage. And if you look at the last 3 months, our thesis is proving right. Many companies, in fact, part of the portfolio companies, they have announced, India advantage kind of a thing. They have decided to outsource more from India. Many of these companies have announced the new capital expenditure expansion programs. Many of these companies are shifting their facilities from Germany to India, and many more such initiatives across our companies, whether it is ABB, Timken, Schaeffler, KSB, Kirloskar Limited. Many companies are experiencing more outsourcing opportunities, particularly from the Europe region. So I think even this can play a very important building block to further accelerate our manufacturing growth. So net manufacturing as an avenue of growth. This is a sector as a manufacturing in totality has not contributed significantly last 10 years, but we believe now the time has come. And PLI incentive, $30 billion of PLI incentives is coming at the right time to make sure there is a revival in this manufacturing. This $30 billion incentive can lead to PLI Capex of $21 billion over 5 years, and it can lead to $52 billion incremental revenue from FY22 to FY25. So we already talked about why this time we are not into that going to be a painful time, unlike 2008, 2009. We also talked about what are the growth drivers for the economy. We talked about China Plus One. We talked about Europe Plus One. We talked about manufacturing as a new avenue of growth. And on top of it, the India's digital infrastructure with a clean bank balance sheet and with an inflection point for non-food credit growth. Now let me talk about a little bit on the valuation side of it. On the valuation side, if you look at FY19, and if you compare that EPS to FY24, because we are right now in January 2023, so we can definitely look forward to March 2024. And even if you assume 11% EPS growth in Nifty, it means in absolute terms, Nifty EPS will increase by 95%. And if you look at the Nifty against that, the Nifty is up only 56%. So there is a big gap between earnings and Nifty. And that means the valuations have corrected from 24 times to almost 19 times. And we believe that that's a wonderful opportunity from investments perspective. If you look at even last 10 years average PE valuations, we are near to last 10 years PE. So valuation wise, now we are fair, considering that Indian economy is going to deliver one of the best growth in the world. Definitely some valuation premium would be justified. And we always believe that market in long term is mirror of earnings growth. And therefore, we think that this is a good entry point for investors to invest with a 3 to 5 years investment horizon. Undoubtedly, there will be volatility as the world enters into recession, and as that negative print number comes over next 2, 3, 4 months, there is a possibility of some correction, which one should not rule out any time. But if one is a 3 years view, I repeat, I think it is a good entry point. In last 3, 4 years, I'm sure everybody would have learned. In fact, we have learned that uncertainty always creates opportunities. If you look at Russia-Ukraine war, it was uncertain time, everybody was worried, but whosoever bought it, he made more money. If you look at COVID time, it was uncertain time, everybody was scared, but whosoever invested during that time, he gave more money. So I think such kind of a correction, such kind of uncertainty, it provides opportunity to create little bit higher returns, little bit more alpha in your portfolio. And therefore, we think we are going to take volatility to our advantage to add to equity as an asset class. How our portfolios are positioned, all three portfolios in terms of sectoral, both our IOP and focus plan and the budding beast. Banking and finance is our large contribution. We believe that, as I mentioned, and we'll talk a little bit about the sectors on which we bullish are. But banking and finance is one sector which we own in terms of both IOP and focus. Consumer is another sector where we are reasonably positive. Within consumer, we prefer discretionary and also we like proxy building material companies. So, for example, the largest plywood companies or largest wire and cable companies or largest pipe companies or largest cable companies, so on and so forth. Engineering, of course, we have a today deep dive into capital goods sector. We'll talk about it at length. Auto and auto ancillary, we from last 2 years, we are bullish on this sector, and we'll also talk about it. Software and pharma, we continue to remain underweight. Remember, pharma we bought in March 2020, and we made huge returns, 60% returns in matter of 4 or 5 months. And from that point, we are underweight on pharma to almost 4% way back in October 2020, and we remain underweight, even today. Software is one sector where we reduced our weightage in March 2022 because we thought that the earnings growth probably come under pressure as the global economy comes under pressure, and the valuations were, of course, not offering high margin of safety. And even today, our view remains the same. Of course, from that point, the valuations have corrected. Many IT companies are down 20, 30, 40%. So yes, we are monitoring it closely, but we believe that the growth will take some time to come back to about last 10 years growth, and therefore, as on today basis, we remain underweight. So that's basically our allocation across 3 PMS plans. Let me also take you through our portfolio characteristics. This is something very important, and I will spend probably 1 minute on this slide. Each of our portfolio, so this is our triple IOP is our flagship plan. All our portfolio companies, irrespective of market cap, we own large companies by profit size. All our portfolio companies enjoy zero or low leverage. Portfolio companies enjoy definitely very strong earnings growth and also very strong return on net worth. And that's what I wanted to demonstrate, that very important is what kind of portfolio quality we are building into. Not only great companies, but also great investment. Because please remember, great companies doesn't necessarily mean great investment. Because if your company doesn't have the earnings growth, then it's not a good company to be in part of portfolio. So we make sure that companies are not only great management and great balance sheet, but they also have a great earnings growth to make it part of the portfolio. And same is true for our AAA budding beast plan as well as AAA focus plan. So AAA budding beast, for example, is offering in mid cap and small cap, but actually is a very differentiated offering, because in this plan we do not buy any micro cap. In fact, we look at the companies by profit size instead of ranking companies by market cap. So to put things in perspective, we have identified about 30 sectors in India where there are only select number of players, and the entire sectors are mid cap and small cap. Like, for example, entire wire and cable industry is a mid cap. If you look at the largest retailer of country, which we own in our portfolio, for example, Trent, when we bought it was mid cap. If you look at the largest mall of the country, is a small cap. Entire plywood industry is small cap. Entire tiles industry is smaller mid cap. Entire luggage industry, there are only 2 players. We have been Safari, oligopoly market. We own Safari in our portfolio, is a small cap. So what I'm trying to tell you is, while the portfolio companies might be small cap, but companies are not small, and that's something very, very important. A differentiated, created a portfolio, and that brings the underlying resilience. All of our portfolio companies, even in budding beast, they are large by profit size and they are debt-free or low leverage. And that gives them power to deliver strong return on net worth, because these companies enjoy pricing power. and that leads to further investment because they throw huge cash flow and that they invest for the future growth and therefore the high earnings growth. And same is true for our AAA focus plan. All companies are large by market share, zero debt or low leverage, high earnings growth, and high ROE. So that's basically, of course, one common line which I wanted to use it is that across our PMS plans, we buy not only best quality, but best management, best governance, supported by low leverage or zero debt balance sheet. And of course, it must have the earnings growth. And top of it, we implement the exit strategy. And that's what creates the long-term consistent performance. In terms of sectors, auto is one sector which I talked about, which we like. And our view from last 1.5 years, our thesis is proving right. If you look at FY22 to FY23, most companies have delivered very strong earnings, and we think that will continue, whether it's a commercial vehicle or whether it's a passenger vehicle. If you look at the margins perspective, FY22 margins were impacted, and that's where the point we said that from here on margins should improve. And in FY23, we will see some improvement, and in FY24, we will see further improvement because as semiconductor chip shortage gets reduced, volumes will recover. The raw material prices are cooling down, steel prices in particular, and many more such commodities. Supply chain also easing, and that will result to improvement in gross margin. So high volume growth and improvement in margins will result into the better profits for our portfolio companies. Banking sector is one sector which we are overweight, and we have a huge weight to this sector, our largest weight for our IOP and focus plan. And I wanted to explain, this slide is a little bit technical. Generally, in banking sector or any other company, normally high operating profit growth means high net profit growth. But in banking sector, it doesn't work like that because after operating profit growth, which is called PPOP, pre-provision operating profit, there comes one more line item in your P&L, which is called provisions. What is this provision? These provisions you need to make for your underlying asset quality. So higher the slippage, higher the credit cost. Higher the gross NPA, higher the credit cost. So if you look at this slide, from operating profit, that is PPOP, to net profit, conversion ratio is normally 50%. But it reduced in FY14 to FY19, if you look at it, it reduced to as low as 10%, and then it turned negative. Why? Because banks had to provide huge provision for their asset quality. Poor asset quality, poor lending resulted into asset quality issue due to whatever reasons, economic slowdown and many more such reasons. However, we believe that the worst part from the credit cost perspective is over. And that's why we increased our weightage in banking about 1.5 years back. And our thesis is proving right. And if you look at the conversion ratio from PPOP to net profit in FY22, we are already at 40%, and in FY23, it will further improve to 54%. So we expect the credit growth to improve, number one. We expect net interest margin to remain reasonably good, number two. And therefore, we expect good PPOP, that is operating profit after before provisions. Because of the less credit cost, less slippages, provision number will also reduce, and therefore the net profit growth will also remain strong compared to very weak underlying net profit growth during FY18 to FY21 period. And that's why we are bullish, continue to remain bullish on banking sector. Coming to the last sector, the capital goods engineering, the Capex. Because, I think we had 2 webinars during the last 4 Zoom webinar conference calls, and we covered capital goods in one and specialty chemical in second. And we received very encouraging response, and that inspired us to keep doing such things. So therefore, today we thought to do a little bit deep dive into the Capex story. Our investment framework for capital goods, these are the factors which we talked about, like localization, product portfolio, solutions, R&D, export opportunities, and many more such things. Total number of companies we mentioned last time is 313. And out of that 100 crores, typically that's our benchmark. In India, just to give you perspective, only about 600 companies makes 100 crore profit out of 5,000 listed companies. So for us, 100 crores means really good number. And of that 31 companies, we own about 7 to 8 companies. So why we own those companies? Where do we see the growth opportunity? Let me now take you through that. But before that, let me give one very important slide, that what happens when capital goods, the Capex revives. Friends, when Capex revives, if you look at 2002 to 2007, BSE Cap Goods Index went up 20 times. 20 times. And after that, for almost 10, 12 years, it didn't move anywhere. And from there, from last 18 months, index is already up almost 2 times. So if the Capex revives, if you focus on if you identify the right companies within this Capex boom, then there is a possibility of making strong wealth creation over next 2, 3, 5 years. What leads to revival of Capex? And this is a slide which we went in detail during our last webinar. And let me talk about 2, 3 important parameters and little bit give me update about what we said last time. And I said that capacity utilization is something very important. And if you look at current capacity utilization, we are already at 72%. So it is a critical point from where the private sector Capex will also start playing its important role. Second important is the industrial credit growth. And if you look at this slide on the right-hand side, the industrial credit growth is also started improving. These are the early signs of revival of Capex cycle. This slide basically gives the segment-wise which segments are going to do what growth over what they did in last 10 years and what they are expected to do over next 2 to 3 years. If you look at FY19, then Capex growth FY19 to 25 is expected to be 9%. And if you look at last period before that, FY15 to FY19, it was just 5%. 5% to 9%. Well, the 9% may not sound impressive, I know, but let me now do deep dive that what are the segments where growth can be 20, 30, 40%. Here is the slide. There are traditional areas and there are new areas. If you look at the traditional areas, the growth is going to be only 6%. But if you identify opportunities in the new areas, then growth can be 26%. And which are those new areas? Data center, automation, efficiency-driven Capex, renewables, and so on and so forth. And let me therefore further deep dive into 2 important growth drivers, smart cities and data centers. First, let me talk about data centers. Friends, India has a total data center capacity in 2021 about roughly 500 megawatt, and that is expected to increase to almost 2,500 megawatt in a matter of next 3 years. And looking from an investment perspective, it means combined investment opportunity of next 3 years, almost 5 to 6 billion dollar, roughly about 50 to 60,000 crores opportunity over next 3 years. And therefore, when we identify the companies, it is very, very important to make sure that the companies have the rightly positioned to capitalize on this growth opportunity. Now, if you look at the typical data center, 12% of the cost is for design and engineering. 40% of the cost is electricals, and 8% is into project management. It means roughly about 60% of data center gives you the opportunity. Because balance is land, building, and something related to civil and all the stuff, which is not basically area what we are looking for. So it means that any company which is catering to this 60% of opportunity, they are the well positioned and they will also grow exponentially high for that particular segment. So for example, we own in our portfolio company, Schneider, we own ABB, of course, our largest holding across our PMS plant. We own Hitachi Energy. We also own Cummins because, every data center, the most critical is the continuing of power. You cannot even 1 second of breakdown. And you have therefore three layers of power. So companies like Cummins benefits hugely because they offer the DG sets to ensure that data center works 24/7. Each of our portfolio company, whether it's ABB or Schneider or Hitachi, they are absolutely well positioned to capitalize on this growth opportunity. Second comes the renewable. In renewable, if you look at the total right now is about 180 gigawatt capacity, and by 2025, this is likely to double over next just 3 years. And again, therefore, companies which are catering to this opportunity, they are best positioned because therefore they can witness much higher growth compared to normal economy growth. So companies like again Hitachi Energy, which is at the forefront globally in providing the energy solution, or companies like Schneider or companies like ABB, they are again very well positioned to capitalize on this growth. Robotics is of course another opportunity, and companies like ABB, which is into automation and robotics, they are absolutely a market leader globally and even in India to offer this solution. So how AAA portfolio stands out when it comes to Capex story? Friends, as I said, there are two segments. One is the traditional companies focusing on irrigation, construction, EPCs, civil work. And then there are companies which we are holding in a portfolio, which have a technology as a mode. And let me explain you what I mean by this. If you look at 2002 to 2007, that bull market of Capex, where index went up 20 times, the traditional companies, their margins were 9.6%. And where are they today? About 11%. If you look at their working capital cycle, it was about roughly 3 months, 100 days, 3 months plus. Right now it is almost 4 months. If you look at their net debt equity, 0.32, right now it is 0.08. And now if you compare our portfolio companies, what was the margins that time? 10.1. And in 2022, where are they? 14.1. 400 basis improvement in margins in an environment where Capex revival is just started, it's just beginning of the Capex cycle. If you look at their cash conversion cycle, it has improved further. From 88 days, it is now 83 days. If you look at their net debt equity, they all are debt-free companies. So now if you compare the traditional companies versus AAA portfolio companies, you will see huge difference in terms of profitability and of course in terms of the underlying balance sheet. And what happens to your ability to cater to the growth and therefore the market returns? Let me give you an example. For example, Hitachi Energy. This company recently received order for 100 MVA for a product called Scott transformer. This is the first time in the world that Hitachi Global in the world first time has received order for Scott transformer for Hitachi India. First time in the world. If you look at this entire project is going to be driven from product design to product engineering to product execution at Baroda in India. In fact, Hitachi Global has then further identified Hitachi Energy for a few particular products. It is going to be the sole supplier for the world markets. If you look at their evolution of energy system to collaborate with customer and to provide the solutions, that's basically the forte of the companies which have a strong product portfolio backed by R&D. So the mode is absolutely completely what I would say uncomparable. It is very, very difficult for somebody to replicate this kind of a business. They not only offer the right solutions, but they also offer the sustainable solutions. For example, Hitachi Energy is decided by 2030 it will be carbon neutral. 80% of the business is now manufactured in India, localized. They are no more, their dependence on import is reduced every year. And they keep doing Capex for further expansion for growth. So, for example, I think last quarter they announced that they've inaugurated their greenfield to double the capacity. So, and similarly, many more such things across our portfolio companies, just not for Hitachi Energy, but that's true for every company. And when you buy such businesses, which are catering to the new growth drivers, where the opportunity is going to be much bigger and sustainable in the next 2, 3, 4, 5 years, what happens to your market cap? So traditional companies, somebody would have invested in 2002 and holding till 20 years, the money would have become 26 times. But if you would have invested in these companies where we have invested, then what would have been their performance? They would have delivered 65 times. So that 65 times wealth creation is because of the technology-driven business. It is because they keep focusing on where the underlying opportunity is. And that's what basically makes them to deliver strong earnings growth with a zero debt balance sheet. with that, I would like to, end this presentation. Once again, I'm thankful to everyone for their valuable time. And with this, now I request Sandeep to please open up this webinar for Q&A. I think we have received many emails for the questions, and of course, you can also post it on the chat box. I can already see questions started coming in. So Sandeep, I request you to kindly take it forward from here on. Thank you.
Yeah. Thanks, Rajesh. Thanks for the insightful presentation. Participant, please post your questions in the chat box in the Q&A sections, and we will take them one by one. Yeah. Rajesh, we'll wait till the questions queues will assemble.
Sure.